This week I'll be going through all the elements that I go through to understand what lies in the week ahead, what moved market in the last week, just to get a consensus view and also understand the key market drivers. I always start my analysis usually with COT data, and Scotiabank COT data is much more simplified versions than the other ones. You can get the raw COT data from the CFTC data. It's a government website, but it is not really appealing at all. So I usually use Scotiabank's. It's easier to understand as well. I'm gonna run you through the basics, and we'll also have a quick look at the positioning. So net USD shorts rise, highest since May 18. There's a small graph here showing us that there is massive increase of dollar selling, or possibly euro longs, which we will be figuring out for this article and the data provided in here. So market is short $16 billion USD. Canadian short positions were somewhat stable, so they haven't moved a lot, but a lot of longs have been adding to euro, shy of 3 billion actually, which was probably the key driver for the net short dollar positioning. Short position on the Australian dollar, they're pulling back as well. The rest are rather neutral. So here's a quick snapshot of the major currencies. So Canadian dollar is still bearish with the net short positioning. Euro, massive $16 billion dollar bullish positions. Pound is bearish, but it's been decreasing. I'm going to show you in another chart. It was nearly shy of 3 billion, and then it's been keep dropping lately. And there's Australian dollar sort of leveling as well. New Zealand leveling as well, close to zero. MX and Mexican peso leveled. So is franc, and there's still bullish interest in the yen, and it's increasing. Same thing with gold. Have a quick look at the last 4 weeks positioning on the Canadian dollar. So if you look back all the way to May, it was near to 2.5 billion shorts. That's been continuously been climbing down. So the shorts haven't been as aggressive as. Long's been on and off. So we had 21,000 contracts, 19, 22, 19. So it's more the open interest that's falling. From the 4-week high of 129,000 contracts, we're down to 125. That is usually not a very positive thing. If open interest falls, you won't see a lot of momentum moves. You will probably see a little bit more choppy market. That's something to understand. Choppy market in favor of the Canadian dollar as the net short positioning are neutralizing. Looking at the other currencies as well. If you look at the euro. So from euro, if you look back all the way 4 weeks back, we had 10 billion long. That's been increased to 16 billion. So it's a massive increase of net positioning, which is very, very positive for the euro. Open interest been climbing dramatically. So 556,000, 583,000, 192. But then it declined last week a little bit, which is mostly because of the net short positioning declined, where longs been keep adding. Now since Tuesday last week, Euro USD declined a bit. Actually, Euro declined against most counterparts. So there's the thinking that maybe those long positions are scaling back a little bit. But it's something we're going to keep an eye on, just to understand where you are. There's quite a good stretch positioning in the Euro. There was a little bit negative risk of moves globally, with COVID coming back and the second wave. That usually means dollar should be going a bit stronger and euro could be declining a bit. So I think it traded shy of 114, then it sort of dropped back. It looks like it's crawling back into the 110 region again. Understandable with the risk picking up. Same thing here with pound. So we had negative 1.7 billion, shy of 3 billion euros on the 2nd of June, and it kept declining. Open interest unfortunately declines as well. However, the pound saw a massive sell-off yesterday, actually all last week, mainly because of the Bank of England announcement. There were thoughts about interest rates going to zero, and that sort of dragged down the pound. Going forward, still expecting a little bit of bearishness into the pound. Mostly reasoning being that the risk scenario is tilted towards being off. However, that was a story of last week. Next week it could change. Open interest has dropped quite significantly, so usually we'd expect quite choppy market next week, and there's not a lot to anticipate in terms of larger moves. But that's good. As long as we know we're in a choppy market, we can strategize for that, and there's tactics we can use for that as well. AUD, so massive, shy of 3 billion, and then it's been keep leveling off. Short positioning's been keep covering. That drove the Aussie up a little bit as well. Open interest unfortunately been declining heavily. That again means we are most likely to hold the ranges. We're most likely to see choppy market. That means market doesn't see a specific incentive to hold long or short, which means open interest is falling off as well. Same thing you can see on the Kiwi. It wasn't great to start with, but the open interest even plummeted it further. So all in all, it gives us a better understanding where are we market. Market not really doesn't have that oomph anymore in it since last week. Most moves have sort of tethered out. We're really waiting for new incentives for long or shorts to take up new positions. That also means sometimes when there's no incentive to go up or down, that currencies that are heavily skewed towards long or short, like the euro for instance right now, they could come under pressure. So if you have no incentives to buy, if you don't have an incentive in the near term to sell, you could see liquidity surges pushing EURUSD down into the 110 level. That's another 200-300 pips, just to try to press these longs out of the positions. That's something to keep in mind now. Quick scan over here. Yen, open interest declining too, but overall longs seem to be picking up again, so there seems to be still interest in yen. CHF pretty much flat, nothing to comment on. Oil longs have been going from adding longs, taking longs off. Open interest somewhat still elevated. I'm interested to see what happens based on the analysis from last week. It was evident that 40 is not going to get taken out, so $40 a barrel is not going to get taken out. So it kind of bounced off that level back into 38. I think going forward we should be chopping under this level, not expecting a dramatic move lower, but I find it very difficult to see in the near term why we should climb above 40. And that sort of ties together the CFTC data. Again, more looking at positioning, looking at why speculators have been adding, looking at the behaviors over the last few weeks, and also understanding what could drive them out of the market or adding to their positions. Also understanding if the open interest is rising or falling, that should translate usually in momentum moves, which based on last week's data we should expect a more choppy market going forward. Gonna have a quick look at let's close that down. We're gonna have a look at real yields. To understand quickly real yields, if you're not sure what it is, I usually look at the 10-year one. Real yields is basically inflation expectation minus what the yield is on a 10-year bond in the United States. The net gives us usually a number, which right now stands at minus 0.6. and this is in inverse correlation with gold. So that's the chart for the real yield. And if I were to invert it, it's moving that way, and it moves very closely with gold. So if I'm going to overlay gold for you, and maybe even change the color. You can see that it moves very, very closely in tandem. Now sometimes analyzing gold might be a bit more difficult than analyzing real yields. With real yields it's more a dynamic of government bond yields, inflation expectations, which is usually driven by oil, which gives us a better understanding where we are. Now real yields been really choppy around these certain levels here. It sort of struggled to make significant headways. And just recently it sort of broke out higher, which kind of carried gold with it. It is important to understand if this move higher will continue, or if this is a short-term top and government bond yields or the US 10-year yields is gonna pick up and drag this whole chart down with it. So we'll be analyzing this in this video as well, just so we can understand where golds are headed. But I wanted to draw this chart out for you, so you get to see the significant correlation that the real yields has on gold. Also, we'll be looking at treasury. So we ought to look at real yields. Have a look at inflation expectation. That's based on the 5-year bond as well. Now, this is the chart for inflation expectation 5 years down the line. Why is that so important? It's a key driver for us to understand where market sees inflation down the line. If you see inflation expectation picking up, that means loads of other different things. That means growth is returning, that means oil is heading higher, that means production is coming back online, because more spending will transpire into more demand, and then will also transpire into higher inflation. So if you can see, since the bazooka Fed popped out their guns since late March, inflation expectation continuously been driving higher, and that usually means that oil has been driving higher as well. So I'm going to show you how oil reacted in tandem with that. These are usually all both key drivers to understand where inflation expectations are headed, and that also means we get a good grasp of where gold is headed to. So if higher inflation usually means gold could be moving higher too, especially in an environment where US yields aren't moving much higher. They're sort of tethered down for now until something real happens. So inflation expectations are picking up. However, they're close to levels where they've struggled sort of to poke higher for almost since the pandemic started, and the pandemic is showing its ugly face again. So we need to be wary if this is gonna top out or keep continuing pushing higher. There's nothing to say that why it should be moving higher in the near term. So probably expecting a pullback very soon. And I'm going to quickly show you what that will mean for other currencies. I'm going to overlay that with the Australian dollar index. So this is the Australian dollar index. I'm going to change the color just so it's easier to distinguish. That's on the daily chart price, and you can see Australian dollar fairly correlated with the inflation expectation. At some point it accelerated a bit more, but major pivots seem to be all in line. Now here's the interesting thing. Inflation expectation picked up, but Australian dollar kept falling off. There's a divergence here. We either have to see if Australian dollar is right and inflation expectations are tethering off, or if inflation expectation can actually climb again to 160. That means there is an opening here to buy Australian dollar to capture a little bit of more upside, especially going to the next week. Now bear in mind, when we look at the CFTC data, Australian dollar is more or less leveled. There is no skew towards buying or selling it. Going by the inflation expectation, there might be a little bit of hope to see it moving higher, because it hasn't been reacting to the inflation expectation pretty much all week. Let's have a look at the weekly chart as well. They might give us a better understanding of where we are with things. But all in all, it feels like inflation expectations have been a bit more positive, but Australian dollar hasn't been reacting. Now, granted, we had a massive momentum move here, so I'd be very interested, knowing that there is limited downside for Australian dollars. There's not negative positioning. Inflation expectations sort of picking up again, peeling off from the lows, coiling up. I'd be interested to plot this against currencies where speculators are overexposed, like the euro or the yen. If you look at the charts that I showed you just minutes ago, there's 16 billion euro longs, and they're shy of 3 billion yen longs as well. So I think we might be seeing some movements against euro AUD and AUD JPY in favor of the Aussie. That's something to keep an eye on. But that gives us a clear picture of things. So we've covered inflation expectation, what drives it. We covered real yields, what drives those. Let's have a look at data flows into next week. So Danske Bank does us all a favor and gives us the government bonds weekly. And it's been updated. And it will tell us what sort of the inflows are into euro and what sort of outflows are. Which means there might be governments that are paying off the coupons, which supplies euro, or there might be governments that are drawing euro out the system because they are selling bonds. And on a week-by-week basis, the Danske Bank research will tell us that. Sometimes you find there are asymmetries, and that's what we're interested in. So we're going to have a quick look at what the report says and what is coming out. So cash flow is still negative, which is usually positive for the euro. Let's have a look at the data. And there is a lot to read out of these reports, very detailed. So the cash flow is negative in the next week for the euro. There's some coupon redemptions, but there's also issuances, and the issuances are taking over. So there's a total negative cash flow of 15 billion euros in the government bond market in the euro, and that's quite significant because these are direct investments. There will be a net cash flow negative, minus 15 billion. So we're keeping an eye out. I believe that is, and in comparison to last week, I tried to recall what it was last week. I believe last week it was pretty much flat. So net outflows and inflows were sort of neutral, but now we have a negative 15 billion going to next week. Quick look who's doing some issuances next week. So week 26, Belgium, they got about net 3 billion. Germany, and also Italy on Thursday. They're quite all attractive. Italy got some good demand lately because the ECB is supporting their bond market, and their yield's been continuously dropping, and investors try to get in on the action and buy Italian bonds while they still offer good yields. So it kind of puts us at the crossroads. Are we gonna buy euro next week? Are we gonna sell it? Are we gonna keep hands off? Euro is a bit stretched, incentives are low, but net flow is on euro negative, which means that's a positive for the euro because there's less euro flooding the market. So I'd be wary about selling euro next week, actually. That especially going into the back of the week. Something to keep an eye out. Especially on the Thursday, that usually usually a day or two before these bond auctions from Italy or even Germany, you find that you get some sizable moves in the euro. So we keep an eye on that. That's intel I always like to be aware of when I do my weekly analysis. And you can do the same thing with all the other governments as well, or the Fed. They got the POMO, and I believe Nordea Bank that covers that really well. Let's see if they actually have the POMOs up. Actually, we check out the Nordea later. That is secondary now. What I wanted to look at is the upcoming news calendar for the next week. So on the left hand side I have my charts running, and on my right hand side I have the calendar. Quickly we want to have a look at what was driving market last week, how market reacted to particular news, and what was the key drivers. So that is last week's calendar on the right hand side. Again, on the left hand side is the chart. On the right hand side, if I have a quick look, you can see that some key market movers in the beginning of the week was, let me show you AUD/JPY, because it's probably one of the most responsive, one of the more responsive assets to risk on, risk off. So we started the week on the 15th of June with a strong risk on move. There was mostly because on the back of where the Fed said they're gonna start buying individual bonds instead of the ETFs, and it was about 7 o'clock in the afternoon that they said that, and you can see the massive move that created around here. Do you see there was this candle here that created that boost? Beforehand, AUD was sort of dropping and rallying, but there was more to do with what happened on Thursday and Friday the week before, which was the FOMC announcement. That kind of got priced in and out again. People were taking their profits, that was driving it up until we reached that level, and the Fed they came up with the good news. Now that spiked prices up, but the whole thing collapsed again, all the way into finish the week on a negative, pretty much where it started, a little bit even lower the week before. Surprisingly, it never took out Friday lows, the Friday following the FOMC announcement. I don't want to confuse everybody too much with it. These levels aren't that critical, but it's important that whatever bearishness there was in market, it didn't seem to be enough to drive everything down, and there was quite a good chunk of bearishness. So after the news announcement, we pretty much didn't have nothing positive coming out. COVID got worse, there's more infections growth, and unfortunately death as well. Retail sales across the board all collapsed, nothing really positive. The core retail sales for the United States, they were positive, they got quickly priced in and out as well, because the details of it weren't actually that good either. Then we had unemployment in Australia collapsing. We had Bank of England, they did not confirm negative rates, they did not add anything to the asset purchases, so everybody expected the 100 billion, which was fine, but everybody said they will need to do more. Everybody was expecting them to do more, but they didn't, and they collapsed the pound that day. Actually, it was collapsing before that, but it really started gaining momentum on the day the BOE announced that it won't be adding any more stimulus, and you can see it just had 2 massive down days. And I believe it's still got a little bit more leg down into next week, but we analyzed that later, just to understand really what happened last week. So there was no more stimulus coming. The good news was all on Monday, and after it was just all bad news until we finished the week. There was the data side of it. So let's have a look at what data is next week. Where are the vulnerabilities? Where are the asymmetries? On the Monday, we will have RBA Lowe speaking, which is the head of the Reserve Bank of Australia. Now, we're not expecting him to make any announcements lately. He wasn't supposed to make any new moves. He made it very clear lately. However, Australia is on a yield curve control. They are controlling their 3-year yield. They're not letting this drop beyond 0.25, and they're not letting it rise too much up either. And if I overlay Australian dollar index over, let's do it on a shorter time frame, so because the yield control is still pretty young, it just started a few months back. Let's do a little bit more intraday, so we get a feel for how responsive Australian dollar is to the yield curve control. Again, that 0.25 level is very, very critical for the RBA. They won't let this drop further, and they're not going to let it rise too much either. They call it yield curve control. Every time you find it dropping too low or going too high, they will pump and dump money in and out of the market just to control that. And Australian dollar index been closely correlated to that as well. You could say in one way or another Australian dollar has got a bottom because the way that they are supporting the economy. Now in any other sense, usually if a counter is doing a yield curve control, that usually means they're pumping money into the market. They should be negative for the Australian dollar. But the way that the Australian economy is working, they're way ahead from all the others because that the pandemic didn't hurt them a lot. They seem to be benefiting from any positive news. That also means if Australian 3-year yields start climbing up from this level, we have a really positive reaction in Australian dollar. And it kind of plays in hand from what we were looking at the 5-year inflation expectations. They've been rising up. 3 years yields seem to be rising up. It really feels like Australian dollar is lagging a positive move here, especially against possibly yen or Euro AUD, but Euro AUD probably to a lesser degree, especially next week because we got these massive negative outflows from Euro. But here we have a clearer picture that it seems like RBA meeting on the Monday. It's not a meeting, sorry. So low speaking could give us a hint that Australian dollar could possibly push higher, at least for the day. Maybe not too much towards the end of the week because risk sentiment could sway things back and forward. But for Monday on its own, I believe there should be a relief rally in the AUD JPY, either early in the morning or later in the trading session. That's something I'll be keeping an eye on. The rest of the day, nothing very interesting. Canadian. So BOC McClellan speaks. We'll be keeping an eye on that. We don't have any consensus about what he's going to say. Lately he's been speaking a few times. He hasn't been moving market a lot. I think because he's a very new governor. He's actually not even started. I believe he starts in July. But it's really difficult to understand when a new governor comes on how to decipher them and just get a feel for what they're trying to do. It usually takes a few months until everybody gets in tune with what the new governor tries to do with their respective currency. He's been very vocal about CPI, so he's a bit worried that the inflation is dropping. That is usually a hint for you that they're trying to devalue their own currency, because if you devalue your own currency, you get more business in and you import higher priced items, which sort of drives up inflation as well. But it's yet to be seen if Canadian dollar can drop on his remarks. On the Tuesday we have flash manufacturing PMI for Australia. I'll be keeping an eye on that. We've got a flurry of PMI data from Euro and also from UK. So going on with what we have from, let's go back to our charts real quick. Let's have a look at GBPUSD just to show you how it reacted to last time the PMI data came through and sort of what the reactions were. So last time we had data was the 21st of May. PMI data was around here, this level, and it didn't seem to like it a lot. Funny enough, now we're in an environment where the pound is selling off on the back of what the BOE did or didn't do, more to say. A bit worrying is that the 10-year yield on the pound has sort of bounced back. So the 10-year yield on the pound has bounced back. If I do the correlation with GBPUSD, it is usually very close, and just on Friday, I believe, it didn't answer the call for the rally. Actually, on Thursday it didn't. So it feels like if on Monday we get a decent pullback, Tuesday the flash manufacturing PMI, there would be our green light to sell pound again against a lot of currencies, ideally even possibly GBPUSD. So let's have a quick look at GBPUSD. AUD is sort of like a brainchild right now. Have a quick look at the daily, see where we're headed. So low's been swept, we're moving sort of back in the range. On Tuesday I'll be seeing where we are with the market. If the bearishness in the pound is still to persist, we should get a leg lower again and sweep Friday's lows, possibly even further. On the bigger perspective, there is no reason why this should reverse, to be honest. This is continuously keep climbing down and down and down. Some to look at on the Tuesday to sell pound, possibly against the Aussie. Going forward, oh sorry, I missed that. So we've got German PMIs and stuff like that as well. It's a bit trickier to understand how that's going to move market. On one hand, you have a lot of political upside in euro, where they're trying to get this Eurobond sorted. On the other side, you got sort of sluggish construction, manufacturing and services. And if any of these going to come out positive, that's a really strong positive for euro as well. So I've been wary to make a direction call on these yet until the data is through. So keep gunpowder dry for this one. Going on to Wednesday, we've got the RBNZ rate statement. Not expecting anything from them. Quick look at the Kiwi yields. Usually when you have a central bank meeting, you want to look at the shorter dated yields, usually 2-year yield. So RBNZ is right now, their interest rates are 0.25, and you can see that the shorter term yields are trading above that, which usually means that can't bode well for the currency. I would expect NZD to drop back onto, the 2-year yield to drop back towards 0.25 before that announcement is due on Wednesday. That also means for, if I do an overlay for you, that also means for currencies that are like the NZDUSD. Now usually I don't keep it as simple. We do a yield spread and there's much more to it. But because we are ahead of a interest rate announcement, we're not expecting anything from that announcement. 2-year yields are trading a little bit too richly, if it makes sense. That means I'll be expecting for the 2-year yield to drop and also to take the currency down with it in the short term. Ideally this all plays out before Wednesday. If it doesn't, and this keeps rallying, I really want to understand why, and it might be opportunity to sell Kiwi even cheaper. But the consensus for next week going, because the 2-year yield is trading a bit richly, I would find it really hard why NZD should be pushing up any further. So probably a little bit more downside for the NZD, especially against other currencies where we feel like they could outperform. Like I was talking about, the Australian dollar could outperform a little bit. So let's have a look at that. See if there's any clues, if AUD NZD could rally a little bit high. It feels like it's sort of topping out though in favor of NZD. Not many clues on the chart, but given the yields, I'll be looking probably to, I definitely won't be looking for longs, that's for starters, but possibly for this to drop lower towards possibly 63 into next week, just to come in line with the short-term yields as well, because they're trading a little bit too richly. For the remainder of Wednesday, we don't have anything that's eye-catching. We've got some key data through on the dollar. So we've got the durable good orders, and durable good orders are important to understand because that means if the details will tell us a little bit if in the United States, if businesses are investing into if businesses are investing, so their expenditure, their capex. That's the word I was looking for. It's important to understand if they do that. If they don't do that, you can tell that the businesses don't believe in the future the market's going to be good. That means they're not going to put out any money, which is not really positive. I don't think this will be a key mover for any of the currencies on that day, but will be perpetuating the obvious moves that have been created since Monday through Tuesday all the way to Thursday. So Thursday will be more of a confirmation of where we headed to finish off the week, if it makes sense, especially with core PCE and UOM coming out. So there's not a lot of heavy data on Friday, and Thursday should be more of a confirmation where what we've created on the beginning of the week to end the week as well with it. Interestingly, we have China holiday, Chinese bank holiday of the Dragon Festival. It's probably worth checking out what happened during the last time they had that festival. Now, bear in mind, right now they are starting possibly some of the lockdowns again. COVID is coming out again. That is not very positive. But I'd like to see what happened last time. So last time we had it on the 7th of June, the Dragon Festival. How did AUD JPY react? Let's go back last year. There's a lot more to consider probably to understand how the currency reacted around that period. If you recall last year around June time, there was just the whole summer was a bond rally. So yen pairs done really well. 7th of June last year, AUD JPY pretty much from when the holiday started just kind of fell off a cliff. Let's check other currencies that are sort of sensitive to risk. Maybe GBPUSD, because we're kind of bearish on that. 7th of June last year, yeah, sort of the same. So by the time the holiday started in China, quite a risk just dropped off a hill. Doesn't mean that's going to exactly happen like that again, but it gives us a feeling of what that festival means for sort of market. And that sort of wraps the week. So we will be starting with Monday, possibly. So I went back too far. On Monday we're starting possibly with the RBA, looking for his hints, but thinking that there could be a AUD positive move there for the day. On Tuesday, looking to sell some GBP. Wednesday, or by Wednesday, I'm expecting NZD to have already dropped into the event. And for Thursday and Friday, we will be getting a better idea during the New York session of where we want to head for the rest of the week and square things up. So that's sort of the whole package I'll look at when I'm doing my weekly analysis, combining data, combining flows, combining CFTC data, combining what happened the week before, understanding where speculators are, understanding who is vulnerable going into the next week. These are sort of the key important things to look at when I devise a plan for the week ahead. I hope you like these videos. There was a little bit background noise with the kids. It's a Saturday morning. It's difficult to keep them quiet out the house. Hope you understand. And I'm looking to do more videos like this in the future as well. Thank you for tuning in.